We're talking about farm finances. We're talking about agricultural economics. We're talking about 2024 and looking ahead to what things look like for the money side of the business of agriculture. Hey, Damian Mason here with a question before we hop into this episode of the Business of Agriculture. If you farm for a living, you employ a lot of amazing technology, from your inputs that you put into the soil to the tractor that you sit in, your combine, and the amazing data that it harvests. But has your soil analytics kept up technologically with everything else in your farming operation? I would venture to say that no, it is not. Sure, you check for your nitrogen, your phosphorus, your potassium, your micronutrients as well. But what about disease pressure? Do you know what diseases and what pests you're going to face next year? No, you don't. But you can now figure that out with Pattern Ag's predictive analytics. Think about it. They can tell you now with testing what the likelihood of facing nasty diseases, things like cyst nematode or sudden death syndrome, what the likelihood of you having this in your field. Then you know how to prepare, how to treat, and where to invest your money. It's using technology to make you bigger yields and therefore make you bigger money. Go to www.pattern.ag to learn more. They are pioneering the way in predictive agronomy. Hey there, welcome to another fantastic episode of the Business of Agriculture. Got a great show for you today. We're talking about money. We're talking about the business side of agriculture. Specifically, we're talking about farm finances and outlook for farm incomes in 2024 and even looking ahead to the next several years. We know where interest rates are right now. They're not very, shall we say, borrower friendly. We know what we're talking about in terms of projections. I'm recording this at the end of April of 2024, just for reference. I've got two great guests on here. They're going to talk about where we are now and where we're moving into in this season and maybe even the seasons ahead. I've got Jason Newton. He's a chief economist for Nutrien. He's joined by John Maman, who is with Nutrien Financial. John has been on here before. He's a good dude. He's an Indiana guy. He's got some interesting stuff, and he's a hell of a golfer, he says. I don't know. Allegedly, so is Donald Trump, but I hear he cheats. Anyway, I don't know about that. If you're watching, you'll notice that these two guys are both they're both bald and I'm not. So you should really tune in here, and I encourage you to do that on my YouTube channel and on my Acres TV. But they got great wealth of knowledge. That's why they have no room for hair in their head, because it's all brains. Anyway, Jason, welcome to the show. You've not been here. John has. Big overriding thing. We're talking about financial outlook for agriculture. It's back to normal, at least historically speaking. Yes?
Yeah, I think, Damian, if we look at where grower margins are, crop by crop, especially for the main row crops grown in the U.S., we're back at sort of more average levels from historically high levels of crop prices and margins and overall aggregate grower incomes between 2021 and 2023. All-time record in 2022 to more of an average level as we look forward.
John, you're going to talk about specifically at the farm level, but everything in agriculture really does boil down or boil back to or roll back to farm incomes, as Jason just said. In 2021, 2022, 23, in both nominal and real dollars, we saw record farm income since records have been kept in the United States of America ag sector. 2022 being the high water mark. We're down, 40% from 2022 is the projection for 2024. What we're saying is we think we're going to be 40% off of that high from just 2 years ago. That is a significant number. If anybody's business revenue declined by 40%, you'd be concerned. And those numbers still are real, yes? And what is your initial thought?
Well, despite some of what Jason noted, we still see some pressure points in the marketplace. We are seeing net farm incomes decrease with the recent USDA information following U.S. cash receipt decreases. That also compounds with government payment decreases. And so there is that effect in the marketplace. There's also a portion of interest rates that are still higher than average and are still inflationary from what many of our consumers would have felt over the last few decades. And so there are still pressures, but I think there's some hope on the horizon with respect to some of the Fed cuts that are anticipated here later in 2024 into 2025. And we compare these to past models. Again, these rates are higher. I don't think they've sustained as long as in the past inflationary periods, but they are expected to come down soon.
Jason, Um, we said before we hit the record button, and I said this historically, if you pay attention to the economics of American agriculture, historically, we've not had anything like what happened the last 3 years, or from 2005 to 2013, which was also an ag super cycle. When we say back to normal, we're not being calloused. We're just saying if you have a historical long view, this looks a lot more like normal. Yes?
I believe so. We're commodity producers in agriculture, and new supply cycle every year and every half year, if you include what's happening in the Southern Hemisphere. And we saw a strong response in acreage and production in major markets in 2023. And that's led to the increase in supply and reduction in crop prices that we've seen. And you hit it. Like, we've been, actually, if we look back 20 years, for most of that time, relative to history, we've been in a pretty strong price cycle. So you talked about 2024 net income coming down. The level that they're projected at on a real basis, we've only been at that level or lower 25% of the time in the last 20 years. So it's been a pretty strong 20-year period. If we look back 50 years, we were below that level in real terms, 65+% of the time. So in the past 50 years, we're still in a pretty good position, but relative to what has been outside of the period between 2014 and 2019, a pretty strong 20-year period, we're in the bottom half of that range.
I want to just make sure that the person listening to this, we obviously, podcast listeners skew younger. So let's just say the person is 20 years younger than me, so mid-30s. They've generally only ever seen, by the time they started paying attention, really pretty darn good times. And then I heard talk in 2015, 16, like, oh yeah, man, things are bad. And I said, no, this is pretty good still. We just saw an adjustment coming off of the catnip of 2005 to 2013. Your numbers, Jason, ferret that out. The last 20 years have been, all but 5 or 6 of them, pretty darn good. But when you go back 50 years, which now encompasses the 80s, which everybody's heard about, the dirty 80s kind of, or the bad 80s, we're still okay. Yeah.
Yeah, I agree. And I think the structural factors that led to that strength in the market that we saw in 2022, like, we don't expect 2022 to be repeated on a regular basis, but the structural factors that drove that remain in place. And that we structural tightness of major grains in China, a reduction in supply and an inability to respond to strong market conditions in Ukraine, the issues with Russia they've been exporting large volumes of grain, but whether they continue to grow at the rate that they have over the past 2 decades is unclear. And potential demand from biofuels, that's another supportive structural factor. So while supplies have rebalanced, we know that the supply chain remains really hand to mouth. And so any crop production issue in a major geography globally will lead to upward volatility. And Brazil has become the largest exporter of both soybeans and corn. And we know Brazilian corn production, 80% of it's a second crop, highly variable production. And so that in and of itself will be a contributor to volatility. So I think we're in a more normal environment today, but normal going forward is a lot more volatile than what has been the case historically.
John, I'm going to go ahead and toss it your way. I'm an ag economics guy, but I hear the volatility, but I try to remember when people ever said it wasn't volatile. I mean, I hear what Jason's saying over here with South America and all this. It's always volatile. If it wasn't, what would they talk about on ag radio and market reports, et cetera, et cetera? I mean, we've had years where corn was in the 3s and then it was pushing 7. So you're talking about a doubling, and that was only a couple of years ago. So I don't know that I buy into it somehow is, and I'm not in any way disagreeing. We're all pals here. I'm not saying, oh, that's wrong. I'm saying it's always been volatile. I don't know. I guess when it wasn't? Late 80s, moving into the 90s, when the corn didn't move off of $1.65, it traded between $1.65 and $1.75 or something like that. Other than that, I don't know that it's any more volatile moving forward. I just think my impression is, and I want John's impression at the farm level, I think it's a bit more shocking because of where we've been. So I'm not saying more volatile in terms of the psyche of the farm person, but I'm saying maybe more hit you in the face, because it kind of just we went from a going 100 miles an hour to sitting in neutral.
I would agree. I think when you look at a macroeconomic perspective, this is normal from a broader trend perspective. But you mentioned the age of your listeners or the average growers that are out there now, and normal to them doesn't feel normal, because I think of the rapid rise that we experienced in the last year and a half, where we rose quickly and five and some percent, 533 basis points in the last year and a half in interest rates.
And by the way, for
the
person that's listening to this that doesn't tune into financial news every day, 533 basis points means
5.33%.
Yeah, we've increased, and that's been in the last 24 months or even less.
Right around the last 18 to 24 months, and that started in early 2022 and rose sharply since then. And so the normal, as you mentioned, that last couple of years of milk and honey and all things great, don't exactly equate to the normalcy of what Jason is referring to across broader ag cycles of what normal looks like from more of a trend line. And so, we compare that, and you mentioned the 80s. Many of those listeners weren't farming in the 80s. They were children, or they were growing up in the industry. And that's the thing, is we can't necessarily benchmark that off of the 80s, because interest rates there were peaking at 21.5%. And we had drought, we had weather conditions and geopolitical impacts that we don't have today. We have different geopolitical impacts, but it's considerably different. And I would also offer the biggest difference between then and now is just the way land prices are set at. You look in the 80s, land dropped, land values greater than 60%, where we see land values now holding steady and increasing. So there are some comparisons that we can draw. There are some ways we can prep our growers and our customers to be ready for market uncertainties, because as you said, there are always market uncertainties, whether it's macroeconomics, weather, geopolitical impacts. But I don't think we can compare what we're seeing now to the 80s from any perspective.
No, and you know what? If you go to enough ag meetings, you hear enough stuff. It's always comparing. The last time we had a blip or a downturn or ag stubbed its toe between to Jason's point, from 2014 to 2019, I started hearing by about the third year, are we in the new 80s? And I said, I can tell that you weren't around in the 80s if you think that. And again, you're not like anyway talking down to them. It's just that you're talking about back then. We had assets in Indiana that the bank didn't even repossess, because it was better off for them to not have it. That's how, people don't understand. I explained that to a younger person at a meeting this winter, and I said, well, let's say you bought something for 10% down or 20% down, because you could back then, and then it lost 60% of its value. The land lost 60% of its value. So you're already way underwater. And then let's also say you leveraged up a new cattle or dairy or hog operation on that, and it was in its first year is when it does a hell of a big depreciation. Now that bank is going to take back something that's legit worth 50%, 40% of the loan. So they didn't even want it back. So yeah, it's nowhere close to that. What do you tell people, Jason? Not even talking about the historical stuff. What do you tell people right now? Everybody wants an answer. They want to know if it's going to go away. They want to know if it's temporary, right? That's the first question. How long is this going to last?
That gets asked. I don't know if there's good answers for that. And anybody that has a good answer to that is probably either lying or telling themselves lies. But I think in reality the best way to be is able to adapt to the market conditions as they are. We know the biggest driver of crop prices is production in major growing areas globally, which is driven by weather, which is unpredictable. And so being able to predict what's going to happen with crop prices is impossible. And so it's best to manage risk, to take advantage of market opportunities when they arise, talk to experts in who are tracking ag markets and input markets as well, in terms of when to price, when to manage risk, and that's probably more John's area. But I think predicting market volatility is really difficult and probably not possible.
I agree, and I'll revisit that in a second. Before I do, if you are listening to this and watching this podcast, please thank my friends at Redox, their sponsor. You can actually not just thank them, you can become a customer. Redox Bionutrients, it's a family business with products for ag and turf that are increasingly applied to acres in the United States and even internationally. This company started 30 years ago by the founder, Darren Moon. He was a specialty crop guy, looked around and said, I think we can get off some of this synthetic fertility products because it's being over-applied, and we can use some of these bionutrient products that actually work with the soil versus being so harmful. So using carbon-based technology, Redox Bionutrients provides superior nutrition, abiotic stress defense, root growth, soil health, and efficiency of nutrient uptake is enhanced. Go to Redox Grows, R-E-D-O-X Grows, redoxgrows.com and check it out. You can learn more about their product line. But you know what? You might have an opportunity here in a down farm income year to use a little less of some of your inputs and a little more of something like Redox and get even bigger results. I thought that was funny, Jason. You said anybody that tells you they can that how long a little downturn in the ag economy is going to last is lying. Yeah, but that's part of what the talking heads have to do. You know, they go on TV. We're going to see this for about. By the way, remember, if you're an expert, you have to say 40% chance. 40% chance means you pretty well believe it's going to happen, but if it doesn't happen, well, I wasn't saying 80%. I did 40%. Yeah. What are you hearing at the farm level, John? I think, just like I called transitory inflation that your Federal Reserve said is going to be only temporary, transitory was the word they made up. I said, no, it's going to be around for at least 5 to 6 years, because when you throw this much government money and stuff, it inflates, it distorts, and that's exactly where we are right now. I think that where we are right now in the ag situation, we're probably going to hang around more of a back to normal, nearer to break even for the next several years.
The biggest part that I would say we need to be ready for is just exactly that. We need to know where we stand with the profitability of our operation. I heard probably too many times when I would have conversations in media outlets and different shows that I knew my interest rate was going up. I didn't know how much. I didn't check the mail. I probably should. I think when we look at this back to normal mantra, we need to revisit break even and know specifically what break even is for our acres, and understand what the implications are of uncertainty, economics, weather, geopolitical impacts, so that we're more resolute than ever in how we make adjustments with break even based on those uncertainties in the marketplace. I think that's the advice we need to take away for the farm gate level, is understand where that break even is, whether you're a row crop grower in the Corn Belt, whether you have permanent acres out west, or whether you have specialty acres in another area of the country, is always understanding what that break even point is and how you manage capital through the ebbs and flows, knowing that we are predicting some relief in interest rates, but regardless of that, the break even piece is something that I think was missed during this rapid period of inflation.
Break even meaning you've got a customer base that truly, meaning farm operators and probably agribusinesses as well, they haven't had to be as lean. They haven't had to be as diligently poring over the numbers as they will this year. And so when things are good, you get a little, I don't want to say careless, but you're tempted to get a little, shall we say, less detail oriented. So is that what we're talking about? Both of you, either of you? Jason, is that what he's saying that we got to do? Just start really getting down to the nitty gritty of cents per acre, cents per bushel of profitability?
Yeah, I, as any commodity producer, it's about being low cost, and you hit it on managing the cost per bushel of output, and that can come from reducing some of the costs, but also through looking for ways of boosting productivity and at the same level of input application and increasing the margin per unit of output.
Interest rates. There is a great deal of optimism that somehow we start decreasing these interest rates. I just heard it on business radio yesterday that it'll start by July. Well, then there's pressure from the political pressure to get some interest rates decreases to get things feeling better before the election, which the Fed is supposed to be independent of politics. We know how sometimes that does or does not work. If it's truly being done based on what should happen, I don't see any reason to lower interest rates in the entirety of 2024. This is just from a guy that's got an agricultural economics degree, but that's my thought. Your thoughts. John, you first. Do you really believe that from the fundamentals, that the fundamentals justify an interest rate decrease in 2024?
I see how our growers are responding in the marketplace, and I think it's for the farm economy. I think it would be a big relief. Again, we talk oftentimes, Damian, that the cash is another input. And imagine a scenario where you price inputs on an annual basis for a crop that comes out once a year, and then through the uncertainty of that cycle with all of the other variables that we mentioned, your price goes up over 5%. And that's not seed, that's not chemical, that's not fertilizer, that's just the cost of money. And so from just a visibility into the panics that our customers have experienced over the last 12 months, that would be a huge help. Now, from the macroeconomic cycle of what inflation looks like and other factors, I think that's where Jason's expertise comes in. But I know from just the shock and awe of what normal we say looks like and doesn't feel like to our younger growers and younger farmers, I think it would be a welcomed adjustment.
Real quickly before I hear from Jason about interest rates being warranted, I got this from Farm Credit Services of Mid-America, and it's an operating loan that I don't usually use, but I keep it open. Interest rate now is 9.6%. 18 to 24 months ago, that number was around 4.2. So it's important to always say, because as we do, John, the person says interest rates went up by 5%. No, actually, they went up by 100%. If it was 4.5%, now it's 9.6%. It's a doubling of the interest rate. And again, if you view money as a crop input, which it is, and you guys are both in the money business, if it was glyphosate or fertility that doubled, well, money just doubled. The price of money has more than doubled in the last 2 years. And I think that's an important thing that you're talking about. But just because that has happened, I don't know that the macroeconomic scenario still would warrant interest rate decreases. You go, Jason.
Yeah, well, like you, Damian, I'm an ag economist, so micro issues are more my forte than speculating on macroeconomic monetary policy. But I think we've touched on it. The factors driving interest rate increases, which is inflation, and inflation remains something that's been resilient and probably hasn't gone down to levels that make central bankers comfortable yet. The labor market remains strong. The U.S. economy remains strong. And so all of those factors, to me, even if there are reductions, it kind of says that the interest rates, if all of those things stay true, remain relatively high as they are today. The other factor, I think that's something to watch on a longer term basis, is that a lot of the issues that have been causing inflation are supply side driven as opposed to demand side driven. And a lot of those supply side factors remain a concern. Interest rate movement is the tool that central bankers have to try to manage it, but it's not necessarily impacting the supply side issues that are a challenge. And so that to me leads to the expectation that they remain at higher levels. And we talk about the last 20 years, higher levels than we've been used to over the last 20 years going forward.
Got it. We're going to go a little more rapid fire on the questioning about then the recommendations and what you tell your customers and tips and tricks and strategies that you're going to employ. And we're going to go through that in a second. Before we do, I want to also tell you about Nutrien. Nutrien in times like this might be your friend, a sustainability program where you can make a little bit of diversified revenue off of your acres. If you farm, you can make more money than just the commodity that you're producing. You can also now sign up for sustainability programs. You've heard about a lot of them. Well, I can tell you about Nutrien, because Nutrien is one of my sponsors here. Nutrien can help you make your transition to some regenerative practices. We're not talking about crazy stuff. We're not going out here and having to hug trees. We're just talking about cutting back on your tillage, maybe doing strip tillage, reduced tillage. You know what? Cover crops. Saves you money because you're spending less on diesel. Also, it's good for your soil. Improving your asset when things are a little bit tough economically is a good idea. So maybe Nutrien can help you make 10, 20, 30 bucks an acre. Who knows? Go and check it out at Nutrien, Truterra, TruterraAg.com. See if you can get signed up for a sustainability program and give yourself a little more revenue per acre. All right, John, what do you tell people? They say, all right, I'm in the business of agriculture. I'm out here producing, and man, things are tight. Nobody can tell me when it's going to go away. What should I do in the meantime? You talked about cost of production. We hear that. Specifically, does that mean I'm just supposed to get out the calculator? Is it really that uncommon that producers don't know their cost of production?
Well, how often have you looked at that operating line going up out of your mailbox, right? You pull that out now, just think about how many, almost a dozen times that's changed in the last 18 months. So I would say be ever present of that. Not
of your operating loans.
Of your operating loans and your costs, right? Maintaining the liquidity, making sure that your alternative lines of credit maximize the benefit that you need to use your operating line, either to grow, to manage uncertainties. I think that's critical because we talked about the macroeconomics of interest challenges in the marketplace, but the lagging indicators from this are always repayment capacity. When we hit that trough, the levels of past dues, the levels of that farm income take a few years to climb out of that for those that are impacted. So knowing what that break even is, being ever present of that is the first step. Managing liquidity in the operation is the next, and really keeping those lines of credit available. Whether you use it or not, you're in the right position because you have that available if you need it. And so, managing uncertainty is, as we all know, is every day in agriculture.
All right,
you're
so
doing the right thing as an example to keep your lines of credit open.
All right, so I got know my numbers, and including interest rates. Maximize liquidity, which means obviously cash on hand. I'm guessing then also you're going to say hold back on the frivolous expenses. That's probably a smart one. Yes,
that would be a good one, and keeping those alternative lines of credit current and open.
Alternative lines. You know what I didn't hear there, Jason? Maybe I'm a little different. What about fudge the numbers with your banker? He didn't talk about that. That's one of my strategies. Good one, yes?
I'd say no, but John would be the expert in that. But I
mean, like when you go in and meet with the banker, when you meet with the banker, and they don't really go out and check when they say, do you still have this, this, and this on your balance sheet? I'm like, sure, absolutely. You're saying that's a bad idea?
I think so.
I would say get ready for that individual to bust out a yardstick and come measure your grain bins, Damian.
All right. What about the situation where, and I know that this is something that we don't like to talk about. When's it time to finally cash out? Have you get it? I mean, at some point, I think that a lot of farmers, and this is something that a lot of my ag people don't really like to talk about, they hang around the game too long. Why would I get out now? If you told them 22, hey, you know what? Now'd be a good time to get out. Why would I get out now? Things are amazing. Like, because the other shoe's going to fall. Now'd be a great time to go ahead and take your chips off the table. And they generally don't. They hang around about 3 to 5 years after they shouldn't, and then it ends up costing them literally millions of dollars of balance sheet or net worth, whatever. Have you had those discussions? Have either of you been in on those discussions on that front? John, you go first.
No, I haven't. We've focused on succession planning in young farmers, knowing the average age of the ag economy. I will also say, though, that during the better parts of the ag cycle, our customers did very, very well to invest in technology, to invest in storage, to invest in farm assets that will help them maintain levels of liquidity during a trough, recognizing that that wasn't going to last forever. And so I think our end has been more on the positive end of what can be planned, and then also knowing that that farm transition is going to be inevitable because we have production acres available. We need farmers. We need to be able to feed the world. And knowing that that transition can be successful, I think is our biggest focus on our end of helping that next generation take over in a positive way.
Jason, you talked about volatility. We talked about all these different kinds of things. One thing we haven't talked about, and if you speak at ag conferences like I do, and sometimes I'm at ag lender conferences, and it was maybe 5-6 years ago before the big run up of 2021, 22, 23, say it's 2017, 2016. They talked about the percentage of their book that is distressed. Do you hear these kinds of numbers? Because the word then was there's a few more percentage of farm operations that are in a distressed situation than you might think. Can you give us some guidance on that? Because it seems to me this early into a little bit of a toe stub, it would be premature to talk about a lot of distress. Give me some guidance.
Yeah, I don't have great data on that. I know that, like, if you look at the distribution of income levels, it varies. There's a wide distribution based on the cost structure of the individual operations, the type of farming that's being done, and certain sectors are definitely more high leveraged and vulnerable to tightening of income levels, as we've seen. So I don't have great data on whether we're seeing a higher amount of distress than has been the case last number of years. Right now, I presume that's the case. And what typically happens in these strong cycles, as we've talked about, is that the highest cost operations tend to be at higher costs. They're more highly leveraged, more highly tied to the highest level of cash rents, and so when market conditions turn, then those are most vulnerable to being squeezed.
John, do you got anything to add on that, on distress percentages?
Yeah, I would say when you hit markets like this, you do see levels of past dues increase across a broader portfolio, and that's a concern, especially when you start lending inputs.
Say that term again. When we see markets like this, we see, you said a term that
we see higher levels of past dues and just annual payments, and those are likely because we see drops in net farm income. We see those cash receipts drop, and with that break-even point changes faster than it ever has for those that are in the marketplace that haven't experienced the 80s. Then you add in different markets where you look out west, and just water prices and access to that is a huge additional stressor. But I would also offer, we said one thing that's different than the 80s. Land values are high, cash rents are still high. So the leverage point of a farm operation is important to note, because those that own their land are going to be in a lot better shape than those are still paying high land prices to acquire land or to rent land. I think when you have major spikes in inflation like we've seen in the last 18 months, those are the pressure points that influence the payables, influence the working capital, the ability to meet short-term debt obligations that many lenders look at. And leverage can creep up in a hurry, especially when we have a younger farm economy and a farm group that are trying to take over. You have to start with leverage to be able to succeed throughout the generations of farming.
Mm-hmm. So talk about delinquencies and distress. I'm not hearing about it when I'm on the road speaking at different ag conferences. Neither of you are hearing it at the macro level, Jason, or at a little more dialed in level, John. You're not hearing it yet.
I think at a micro level, it starts to become more of a worry, Damian.
Yeah.
Again, because on an annual basis, when you start getting crops out, that leverage point can change a lot faster than it can or reflect in a historical cycle. So I would say there's concerns in the marketplace just year over year because of the decrease in net farm income and other payments that would go in to help support farmers with the economy the way it's turned out the last year.
Jason, you got anything on that? You're nodding your head. So for the people listening that aren't watching, you're nodding your head. You got something on that?
No, I agree. I think it's maybe something too that we're fairly early into the cycle, so we're coming off of, as you mentioned, it's a record 2022, really strong balance sheets going into 2023, which saw a reduction in farm income. So we're just getting into the planting season and growers applying inputs and going into that period. So it may be something to watch out for as we get into later 2024 and into 2025.
I'm not being in any way calloused, but I would say if you're already distressed 4 months into the first year of a downturn after 3 to 4 years of some of the most amazing numbers ever, maybe this isn't the right business for you. And I'm not in any way being callous, but this is, like you said, Jason, this is really early to be exhibiting distressing levels of finances to where you're almost either bankruptcy or out of the business. We just haven't had enough time of a downturn. Is that an accurate statement?
Yeah, I think that's right. And we saw, and I'm trying to think back, like there definitely was more discussion of that in that 2014 to 2019 period, especially as we got later in that time period. In certain sectors, like the dairy sector is always one that's cyclical and subject to those financial challenges.
I think if you look at dairy, there's as many months that and hogs might be it this way now. There's more months where they lose money than they actually make money as an industry. You're nodding your head, John. Is that about right?
I wouldn't know. I know from practical experience of listening to your stories of horses and equine endeavors that ring in the back of my head, and some of the jokes you made on that come to mind, Damian. But
all right, well, the dumbest thing you would ever do in your life is be in the horse business. But then aside from that, if you want to lose money, it seems to me that the dairy business, and I grew up in it, and I went my ground to a dairyman. There's a real opportunity there to work really hard to not make anything. It's a special kind of love. All right, last thought. Usually after a couple of years of some level of economic downturn in ag, we start seeing a move to consolidation, sometimes a pretty rapid move to consolidation. Are you guys hearing, seeing, feeling anything on consolidation yet? At the producer level, at the retailer level, even at the manufacturer level? Jason, you're nodding your head. You go.
Yeah, well, consolidation has been ongoing for the past 100 plus years.
100 years. It's been going on.
So it's always happens, and it will happen. And in the periods of strong economics, it perhaps slows, but that's something we'd expect to continue going forward. And technology evolves to make larger, more advanced operations possible. So consolidation will continue, and it's likely to continue in the retail network as well as growers get bigger. Retail network needs to evolve to service a larger, more efficient customer base. So you see consolidation through the supply chain.
Consolidation has been going on for 100 years. I did another episode, which will be releasing soon, about consolidation, and it's a bad word, and it's always people have so many different opinions on this. Small farms can't do this or whatever. And I'm like, well, what does that even mean? Define those. It becomes a very emotional versus, shall I say, rational discussion in terms of the numbers. But yes, usually after a couple of years, 3 years of agricultural economic downturn, we see pretty big ramp up in consolidation. And I'd say that's what we're going to see in 25 and 26 is my prediction. But I'm just a former comedian with an agricultural economics degree. By the way, if you're listening to this, you're probably saying, hey, that's really a good discussion. I'm glad you got Jason and John on. If you're watching it, you're probably realizing that I'm wearing this really cool jacket that's got a floral sort of tropical theme, because I thought this is going to be some bad news. It's a heavy subject. What if we lighten it with basically a Hawaiian sort of vacation-looking blazer? So if you want to see this to make yourself feel some island vibes, go to my YouTube channel. It's just go to YouTube and type in Damian Mason, and please hit subscribe. I really want to grow our distribution list over there, because the cool stuff I put on YouTube, more people see it if you subscribe. Also, you can check out this show at Acres TV. That's right, the streaming platform for agricultural content. I'm on there. It's the Damian Mason Show. I'm sorry, it's the Business of Agriculture Show with Damian Mason. So just go there and check it out. John, get me out of here. You came at me with this idea that maybe now that we're in this new year of projected declines in income by 40% off our high off of 2022, 25% off of what was made last year in 2023. So get me out of here. Closing thoughts, agricultural numbers, farm income.
Make sure you revisit that break-even point, know where the levers are to be successful, because in a down market, somebody will grow, somebody will succeed, and there's opportunity even in projected peril. I will say, you mentioned uncertainties. The one certainty about that is that farms will continue to get bigger, and that is a nice jacket. And that's how I know we're in a good place. So all I need to know is where I can find one like it, and then turn it over to Jason.
Jason, you get the final word here. If you say you want one of these jackets also, I'll know that I am truly a fashion leader, maybe even like what we call a trendsetter. What do you think, Jason?
I don't know if I could pull that jacket off, but if I could find one, I'd buy one, I think, but it's probably a difficult thing to find as well.
Closing thoughts, agricultural economics. You see a lot of stuff. You see a lot of territory. You see all of America, and you're looking at the numbers. One big takeaway or what final thought or anything that you didn't share that we should have covered and I didn't ask you?
No, I think we've covered it. I think I'd just double down on being nimble and adjustable and watching market conditions as they evolve closely. It talked about the projected farm income for 2024. We're only at the end of April. Yeah. Still have a crop to grow. There's a lot of potential variables that can come in and drive market direction from this point forward. And just given where we are in the cycle, there's asymmetric upside. So I think there's reason to continue to be optimistic. But to John's point, to also control what can be controlled from a cost perspective and looking forward.
I'm optimistic also. I mean, when we say this is a more return to normal historically, it's not because we're in any way being pessimists or negative Nancy's. We've seen it, and it's where we are, and I think there's still plenty of room to be optimistic. And I think it's a little early to be to be pulling the panic alarm is my thought also. Jason Newton, if somebody wants to find you, are you on LinkedIn? Is there a place that you put your commentary that these people can find it within Nutrien as the chief economist?
Yeah, I'm on LinkedIn. You can view investor materials and public information that Nutrien is publishing. And through customers, we also publish presentation materials, commentary on agriculture and crop input markets.
Love it. John Maman's on LinkedIn. I know that. It's John, like the normal spelling, Maman. So thanks for being here, guys. That's John and Jason. They're both with Nutrien, one with Nutrien Financial, one with Nutrien and the chief economist. The other one is the senior, what is it again?
Senior Director of Business Development.
And a scratch golfer, I think. We're supposed to get together. We're supposed to get together and swing the clubs now that I'm more than 3 years into being a golfer. So anyway, maybe I'll wear this jacket. So next time, thanks for being here, guys. Really appreciate it. If you enjoyed this episode and found it insightful, please share it with somebody that can benefit from it. 340 or 50 episodes that we've cranked out. Man, oh man, lots of great stuff. Share with somebody. And please, thanks for being here. Go to my YouTube channel, hit subscribe. Till next time, thanks for being here. I'm Damian Mason, and this is the Business of Agriculture. Hey, thanks for being here. This episode of the Business of Agriculture was brought to you by Pattern Ag. You've heard me talk about Pattern Ag because I think it's a pretty cool concept. New technology that allows you to predict the problems you're going to have and therefore treat them before those problems cost you money. What kind of problems am I talking about? Pests, and disease. Things like cordon rootworm, sudden death syndrome, cyst nematode, and a whole bunch of other bad things that happen out there in the field that can cost you money. Guess what? Pattern Ag will let you find out ahead of time if the disease or the pest pressure is there, and therefore you're treating it before it costs you any money. What a great concept. Go to pattern.ag, that's www.pattern.ag, to learn more about their product, their technology, how it can make you money, save you yield, and also where you can find a rep that can come out there and do the work for you. Pattern.ag.